Good morning, good afternoon, good evening. It's Friday, December 22nd, and welcome to the latest episode. This is Mark Yu,
And this is Wawi Santos. Hello,
and
everyone.
this is the episode 93. Welcome to the Mark Yu and Wawi show. So, just a disclosure, we're not registered financial advisors. We're both healthcare professionals here in the USA. Um, so we do this out of passion, and we at least try to record once a week, take a look at the financial markets and see how our investments perform over time. So I guess we're gonna jump on to our sentiments as what we usually do on a weekly basis. So we'll start with the American Association of Individual Investors. uh, so for as of December 20, there are a lot more bullish investors, 52.9. I think this is the highest we have had for this year, 52.9 compared to 51 a week ago. And look at the historical difference. Historical average is just 37.5. Meanwhile, the bearish investors, it went up just a little bit by 1% points from 19 to 20.9. So what do you think about this, Wawi? More bullish?
Oh, yeah, definitely a lot more excitement
Mm.
on the market because of all the. Well, it got jump started, of course, last week when Jay Powell made his statement, and followed by even today's leading economic indicator showing
Right.
inflation is down and, a lot of good signals coming online.
Mhm.
So it's looking at the positive, and even the crypto market is rallying with all this talk about uh, ETF, Bitcoin ETF. So there's a lot of excitement that's pushing the momentum of
Yep.
this bullish trend for this Christmas season.
A lot of animal spirits, looks like, joining the
Yes,
Santa
yes,
Claus rally.
yes.
So,
Exuberant animal spirits.
uh-huh, above 50%. We never saw that for the year of 2022. And right now, as people, as experts were prediction this year, it never happened. Was, we were achieving all of this all-time highs if the recession had played out or the projections, but it never happened. But interestingly, while we have seen the more bullish sentiments, actually the S&P 500 for the past 5 days, well, it's up 0.72, but it's not as wildly up that we are expecting, knowing that there are a lot more bullish people. I mean, investors turning out more bullish at this point in time. The volatility, let's take a look at that. The volatility is also up, interestingly, 6.4%. Oh, this is for the Nasdaq, but let's look at the S&P. Yeah, similar to the S&P volatility, almost 7% up. And the Nasdaq for the past week, it's up. Wow, it reached 15,000. It's up 1.32 points, 1.32% for the past 5 days. So, in my opinion, if I was gonna see this 52%, I was maybe expecting a little bit more from S&P 500, which 0.71 is, it's still positive, but I was thinking maybe it could go above 2% or something like that. So,
Well, we're
but
seeing more of these big jumps from certain sectors on the real estate and the financial sector.
mhm,
Um, those have been repressed from last year's high interest rates,
right,
including some of these information technology companies and the communication sectors,
good
individual
point. Yeah,
companies, yeah, that had been depressed
true,
during
true.
this year.
I think yeah, that's a good point because knowing that so far this year it's always been tech sector that's been going up. Yeah, I think you're right because the weak performing industry are now trying to catch up. So it's a good sign actually. Now that you've pointed that out, it's better to have more industries joining the rally, not just yeah, you're right. So look for the past month, real estate, like you said, is the best performing sector, followed by basic materials and then industrials, financials. So technology is not actually as a strong performer, but it's still pretty good, 4.9% as a group for the past 4 weeks. But like what you have pointed out, Wawi, those lagging sectors are trying to catch up at least. Utilities, not so much, is still a laggard, but each and every sector is actually in the positive, in the green for the past 4 weeks. So that's a good sign. I think the market rally is broadening. That's a good point right there.
Yeah, I would not discount the utilities because I read an article on Morningstar
Mhm.
that is comparing, you know, um, discounted uh, returns on financials, I mean, on utilities
Mhm.
this next decade. And they're seeing that certain utility companies will increase their dividends in the next 10 years. So if you're looking for some stable income, you can look at, away from treasuries, you can look at utilities for those forecasted increase in dividends.
Right. And now that we're experts are again now projecting that the Federal Reserve is done with the hiking up rates. So if people are going to start to look for income source, utilities is also or can be a good you know source of income because they usually dole out a payout for dividends for their
Yeah,
investors.
and
So
I'm
that's a good
mentioning
one.
that because of this trend that I'm seeing, that we may be on a early cycle, if not yet on a recession. We may be going, if we didn't have a landing, I'm
Mhm.
thinking we're in an early uh, cycle of the business cycle.
Like
So utilities is usually part of that rotation.
I see. That's a good point, Wowie. There's something to watch out for next quarter at least, next 3 months. See how utilities perform since it's been a laggard this year. So for the other sentiments that we take a look at the fear and greed, we are now in extreme greed, 78 points.
Wow.
Oh,
Oh my God. I don't think we've ever seen extreme greed until now, right?
yeah. Oh, by the way, extreme greed also was last week too, 80 points. So
Oh, really? Oh,
yeah, it's
okay.
we've been in the extreme greed territory for the past couple of weeks. So
Wow.
that's something to cheer for, especially now that we're ending the year on a high note. So hopefully it continues to 2024. Um, Market momentum. Yeah, looking at the graph too, before we jump on the market momentum, we have been in extreme greed actually since December 15th of this month. So it's been holding up strong. And we've seen that kind of performance too mid this year between middle of June to July, last week of July. So middle of June to so about a month. So with this one right here that we're experiencing started in December 15th, just a week ago, would last until end of January or even more. Should we see more bullishness? So hopefully this carries on to the next year, but hope is not a good, uh, you know, basis to hold your investments for the long term. What you want is good, sound fundamentals at the right price.
Yeah,
So,
you're right about that, Mark. You
Mhm.
still have to look at earnings, you know, uh,
Right.
for next year. And of course, falling rates.
Yeah, if anything, we would like to see what the valuation is of the S&P as a whole. So right now we are at 26 points, where usually we are at 15 median and 16 on average. So we're definitely overvalued at this point, according to the P/E ratio. So, just be on the look there. You don't want to put all of your eggs in one basket and just, you know, see or hope that the market would continue to go up. But we are indeed in a strong momentum, as we are going to see here in the 125-day moving average. So we have never looked back since November 8th. So since we have pierced through that line, we've never looked back. We just kept rising. So now we're at the point where we're actually trying to reach 4,800 mark. I don't think we have reached that high in the S&P 500 history. The highest that we have been was 4766 back in
Oh, so
December 31.
so
Uh,
we're on
yeah,
record right now.
yeah, we're actually, yeah, you're right. Yeah, this is a new record right now that we are record territory. Well, look at this, 4766. Yeah, that's the highest we have been. 47.
Unbelievable. You
And right,
see, unexpected, right? Unexpected.
unexpected. Yeah, and right now it's 11:21 a.m. Friday, so the market is still open. Christmas is around the corner next Monday, but right now the market is strong and bullish, and it has momentum on its back. The stock price strength, new 52-week highs on the NYSE also is indicating of a strong sentiment. 5.23, the highest we have been for the past year. So a lot more companies are hitting new highs at this point. The stock price breadth, the McClelland Volume Summation Index, it's also going high right now. So not as high as back in July, but it's trending up there. In call options, a little bit of uptick there, but still way down. 0.64 compared to 1.08 back in September.
Wow,
So,
definitely a Santa rally to remember.
and Torelli, yes, sir. I
Yes,
agree
this
with
is
that.
a Christmas to remember for those investors out there, especially in
Yes.
our group.
Yes. For those who are doubting the market, well, here's the market for you. When everybody's thinking that we're going to go into a recession, we're going to new all-time highs.
Unbelievable, Mark.
I
Unbelievable.
can't, yeah. And the data is showing our portfolio is definitely indicating it, despite a lot of beliefs that we were supposed to hit new lows at this point, recession by third quarter or fourth quarter. So, yeah, so since the start of the year, technology obviously is the best performing, communication services. The worst performing are consumer cyclical, utilities, and defensives. For the past quarter, past 3 months, technology still is the best performing, real estate, and then basic materials. So basically, each and every sector is in the green except for energy. Only oil is down as a sector, negative 3%. So off we go to our spread, the 10-year versus 2-year spread. Obviously, it's still negative. So for the past 5 days, let's see, it actually went up. So usually, if this goes up, our theory is the market would go down, but it didn't happen.
Yeah,
So
look at that trend line. It's just unbelievable just looking at that trend line, Mark.
yeah,
It's
it's
just
going up.
the resistance and support lines are so strong. I don't know. I don't think,
Yeah,
yeah, on the dip in September 2022, it's just compared to now, it's just amazing.
yeah,
I could have not imagined.
true. So despite the increase going positive on the yield curve, the S&P actually is still up 0.7%. Maybe that's why it's not as strong as the uptick, but for the past 3 months, it has been up as well. Negative 6 points. It started with negative 0.67. It's now at 0.43. And since the start of the year, the yield curve has slowly uninverted actually. From negative 1.1 low, we're at negative 0.43. Actually, it just turned to 0.42. So it's slowly uninverting, but regardless, the S&P 500 is set to reach a new all-time high. So I think our theory can't be uh, applied anymore at this point.
Yeah, I'm just gonna scratch my head on that.
So yeah. Now we're gonna take a look at the fund flows. So this is as of today, this morning. This was published by Reuters, but the data source is BFA or Bank of America. It says cash, the big flow winner of 2023. I don't think there's any doubt to that. Since we've been doing some recordings on a weekly basis, every week, billions, if not tens of billions of dollars have steadily flown into money markets, right, Wawi?
Mm-hmm. And now it's flowing back into the equity market.
Yes. Well, according to this data, it says global investors put a record $1.3 trillion in cash this year. They also pumped in a record $177 billion into treasuries in the US. And let's see. Outflows, meanwhile, okay, this is on a weekly performance. So a little bit of selling, $26 billion out of cash, which is tiny to the $1.3 trillion that came in. They also pulled out. Yeah, you're right, Wawi. So where else would the investor put the money if they start pulling out from cash? They pulled out 26 from cash, billion, 26 billion, 21. Oh, okay. They also pulled 21 billion from stocks, 3 billion from bonds, 300 million gold. Interesting. So investors shed stocks at the highest weekly rate since December of last year. Record largest outflow from tech. So this is quite interesting.
Oh,
So they pulled the money out the highest weekly rate since last year, December, and the largest outflow from tech stocks in 15 weeks. So I guess these are the people that are kind of like, what do you call that? Cashing in their gains at this
yeah,
point.
realizing gains and rebalancing and tax loss harvesting.
More likely, yeah, they're trying to probably rebalance their portfolio. Yeah, more likely because technology, as we have just talked about, is the best performing sector this year. So if you wanna, you know, realize some of the gain, put those money to work somewhere else, it's the time, as well as it could offset your capital losses somewhere else. So that's a good way of rationalizing what just happened this week.
Well, if you think of it, the market is always pricing things in. As soon as the market priced in Jay Powell's statement, people started cashing in, and all the algos are doing the same thing.
Right.
A lot of the market is like 70% algo right now.
True.
So
Most of
what
the
would it do? So
investors.
the rational thing to do is get the money out and then wait for a dip, and then the algo will put it back in.
True. That's a good point there, Wawi. Really good point. Good thing we dissect these market movements on a weekly basis. It kind of gives us a good heads up, good grip on the market. Much complicated Wall Street market. So this is a publication from Financial Times. Morgan Stanley chief predicts markets will take off when Fed
All,
begins rate cuts.
oh, okay. Well, wasn't Morgan Stanley one of those that were saying something bad is gonna happen?
Yes, it's always been it's chief investment officer. What's his name?
Mike
Michael
Wilson,
Wilson.
right?
Yeah, yeah.
Well,
Well,
this guy is not Mike Wilson. This is James Gorman, looks
yeah, he's
like.
he's a CEO, and I think he's gonna be uh, I think he's gonna be the one retiring pretty soon.
Oh,
Yeah,
okay.
yeah. Gorman, who hands over to his successor Ted Pick by January 1st.
I see.
So he's making a
Okay.
big call, but he's gonna resign. I mean, he's gonna retire pretty soon. So there's no. I don't think we should put much weight on it, but if anything, Morgan
Well, he's
Stanley.
going out. He's going out in a good cycle, so
Yeah,
it's a good time to retire, I think.
true. Yep, that makes sense. All
Wow,
right.
unbelievable. A
And
change of narrative for sure.
mhm. And next one is from MarketWatch. American households are invested in the stock market like never before.
Wow.
That could mean 7 lean years, says Wall Street veteran. So a little bit of a negative take on this
Hmm,
one.
interesting. Why 7 years? Why not 10 years?
Let me see what it says.
Quite a call.
Yeah. So I think every time a lot of people are invested, like look at this graph, we're close to 40%. So we have never reached that point since 2000s, the tech bubble, and between 65 and 70.
Well, I definitely feel a lot of FOMO. So personally, I have a lot of FOMO right now. But it's rallying, so people are just now, I guess, coming off of their fear, and now they're in a FOMO situation.
True. Well, this is a quote from him. It says, from 1952 to 2016, long-term total annualized return for the S&P 500, including reinvested dividends, is 11.4%. However, when the household share is one standard deviation above its long-term average, stock returned just 4.1% over the preceding 7 years. So we are now 1 percentage points, if not mistaken. Yep, above one standard deviation right now. That's where we are at. So he's looking at 4.1 annualized over the preceding 7 years. The opposite is true when household share of stocks is below long-term average. Stock return a large 16% over 7 years. Well, this year, 24% for the S&P, 44 for NASDAQ. So I guess what rationally what we could think of is could just be a return to the mean, return on average.
Well, you could also look at how much money has been put on the indices over the years. So people have been predicting there should be a slower return on the S&P 500 because of the massive investment that investors and companies and pension funds have put on the S&P 500.
Mm-hmm.
Um, so, well, anyway, even the equal weighted funds like GSEW is doing so hot right now. It's just looking at the 5 year of the GSEW, you could see it does not follow the S&P 500 trend line. So you could see the bigger picture here if you look at the equal weighted uh, what do you call this example of the S&P 500.
Right.
You won't see the massive run up because if you're just looking at 7 companies or how many that is
Yeah, the
just pulling.
Magnificent Seven.
Yeah, the Magnificent Seven pulling record highs, but how long can it do that?
Mm,
So you have to compare it with an equal weight index to tell the bigger picture.
true. So it's one thing to keep an eye on, especially. Um, so now we're gonna slowly take a look at the consumers. How are the consumers doing? So
Ooh,
these comprises of 70%, if not three-fourths of the overall U.S. economy. So quite a negative indicator here at this point. Car owners fall behind on payments at highest rate on record. So the U.S. as a whole, people need cars in order to get from point A to point B. That's, basically, there's no going around it except you live in densely populated areas with good bus and train system like New York. I don't think even California has a wide enough public transport system in comparison to New York. But most of the time, people need cars. So if people, starts deprioritizing their car payments, risking it all just to afford their daily living expense, that's a warning sign of a weak consumer. And somewhere down the point, it could break the economy if it continues down to a down spiral. So the risk of vehicle repossession is rising for many Americans facing a budget crunch. Well, I thought
Yeah,
it was
that's a sad fact. I think that's coming out of the high interest rate scenario you know, the past year. So if you got, 5 or 7 years to pay off a car and you just got it a couple of years ago, you're paying high interest rate on it. So they're pricing in like three rate cuts next year, so maybe
true.
they can refinance, and that should help some of the people that are struggling with their payments.
Yeah. And for some reason, I saw this being shared online, but this was actually an old article, October 21st of this year. So just something to keep in mind on. But regardless of that, that was before. And right now, this was just published this morning. It says consumer sentiment finishes 2023 on a high note as inflation wanes.
So they're buying cars. It's Christmas time. People are buying cars right now.
True, true. So people are staying positive at least. Consumer sentiments 5 month high this month. Perhaps a good sign for the economy as a new year gets underway. The reading, according to University of Michigan, it jumped from, well, not jumped, but it inched up from 69.7 to 69.4. Americans feel about their own finances as well as the broader economy. So we are on a rebound. Mhm. That's a positive sign. So, like what we just mentioned earlier, the leading economic indicator just came out. So we are actually negative 3.5.
Ooh,
So the only positive here that I can see is the financial components, which is the S&P 500 that's turning on the upside. That and the weekly claims
unemployment. Is that it?
and new orders. Yes, unemployment insurance. Let me click on the link here just to be sure.
Yeah. The orders for manufacturing.
Mhm.
Yeah, I got that report earlier this morning. I think I'm putting a lot of on our messenger group. That's
Mhm.
one of the comments of one of our members. And hello to Christina Talley. I'm mentioning your name here. Anyway, I can't help it but to post a lot on the messenger group because we have a lot of news coming in, and
True.
if you just back read today's uh, messages, you would learn a lot how I think about and how I process the information. And if you ask questions, it would make more sense. I think how you can interpret my readings on the news and the data that's coming in.
Right. Yeah. I guess that's one thing to keep an eye on. It's really good that you have shared those information, Wawi, and it gives us a good
A
reflection
feel,
on the market. Yeah, exactly. But the lay, like what we had just pointed out, so it says here it declined again on November 2023, following a decline of 1% in October. So let me see how many months has it been. I don't think they're keeping count anymore. It's been negative since here 20, I would say middle of 2022. So that's a little bit of a precursor there on the upcoming months. Some of the
yeah.
experts are projecting that we might hit recession just because of sometime in the future, just because of this leading economic indicator is indicating already.
Yeah, so it's just impossible to say. I'm still thinking the recession can happen, like you said, but we just don't know the extent of it or how long it will last. It's just hard to tell. And the question is, is the Fed, the Fed was late, and then they were late seeing the inflation. They were late addressing the inflation, and now they could be late easing. So there's a chance for definitely a chance for recession.
True.
It's because they're depending on lagging indicators, so they're always gonna be late.
Yes. And it's
Unless they know something we don't,
Mhm.
which is most likely the case.
Yeah, usually they probably have some more information, but yeah, we just have to follow through what they have been implementing. And
Well,
we could,
well, on the positive side, you have to look at 30-year mortgage down to 6.83 today,
mhm.
and um, there's a lot more bargains on cars right now. They're trying to get rid of their old inventories. So this could be
So
a good time to buy a new car,
a little
but
bit
I
of,
won't buy one until the interest rate goes down.
yeah, for sure, because that's a major contributory to the monthly payments too. So this is another graph which is interesting. This is from Bank of America. It says here the crowd is cutting cash levels aggressively. Now we are down to 4.5. And Bank of America reminds us that there's a trigger sell if the cash falls 4% or lower. So a lot of money, like what you said earlier, Wawi, have been pulled out of cash at this point. And a lot of that is piling in to the stock market, obviously. So let's see how well that ends up. But right now, people are in the FOMO, like you said, Wawi, and they're trying to buy stocks at the last minute. Thus spawning the Christmas Santa Claus rally that has actually started more than a month ago already. So it's one
Yeah,
thing to keep an eye
I was
for.
a net seller this month rather than a buyer.
Mm. So that's
So,
good. Going up against the trend.
mhm.
So here are the successful forecasters that nailed this year's rally, and let's see what they think about next year. So number one, of course, is Tom Lee. Fun strat,
I love that man. He's
4750.
been right this year.
Yeah, 4750. We're right there. He
And
projected
it,
that at the start of 2023.
and I was like, "Ah, really, really?" And then he nailed it, and it went higher than that.
Yeah. So now let's look. Is 2024 for next year target 5200?
Yeah, well, on the interview that I heard him say, he said 5250.
Oh my gosh. It just
So,
increases every
well,
time.
and he makes a good argument on it, right? But it's
Yeah.
like it will happen, of course, without a recession, or if the recession is brief, it can happen. I just don't know, okay? But he's saying it.
Yeah.
He's
Uh,
calling it.
Another guy, Brian Belsky of BMO, he has a target of 4300. And obviously we have surpassed that. And he's looking at close to Tom Lee's 52. He's at
Ooh,
5100 by next year.
wow.
Yeah. Let's see. John Stall's Fuss, Oppenheimer. Closing year at 4400. Okay. It used to be one of the riskiest on Wall Street, but he did
Mm-hmm,
nail it earlier on.
mm-hmm.
So he's saying 5200,
So
2024.
there's a consensus.
Yeah, but remember, just a month ago, we were looking at JP Morgan as the lowest S&P 500 target, somewhere at 4,000. and the
Yeah,
Morgan
yeah,
Stanley. Yeah, those big Wall Street banks, they think we're going to go into recession next year and we're going to end up low. So,
exactly,
so this one,
exactly.
Bank of America, Savita Subramanian. So she's been shifting her target price 4,046. So I don't bear much weight on her projections, but it's just good to mention since she's already in this article. Her target 2024 5,000. Sees a soft landing. Ryan Dietrich, Carson Group. Well, it doesn't show here. He had no price targets. So yeah, 5,200 looks like Wawi. 5,200.
Ooh, I guess we haven't seen anything yet. Ooh.
It's gonna be a crazy bull market if that happens.
It scares me, right?
Yeah, because there's no telling. Like earlier this year, we thought everything is just gonna, fall down. But interestingly, the worst performing sectors last year are the best performing sector, and the best performing sector last year, which is energy, is the worst performing sector this year. So it's kind of like give and go. It would have been easy to make millions of money just to look at that and I'm gonna apply that for next year, but there's no telling if technology is gonna be the worst performing sector next year. Google has tons of cash, hundreds of billions. Apple, Amazon, Facebook, Netflix is earning on their streaming. So it's hard to tell if big tech is gonna go down south. If that's gonna happen, it's gonna be bad for the all of the economy because those companies are large cash flow generators, so they won't go bankrupt. I don't see them going down, honestly. So that's 5,200. I guess that's achievable.
Yeah,
Uh,
yeah, yeah. Definitely with with the rate cuts priced in. Yeah, definitely.
for sure, yeah. 4 rate cuts. Some people are actually thinking of 6 rate cuts. I don't know why, but that's crazy.
Well,
That's kind
because
of quick.
they're behind, they're behind. They could be behind. My thesis is the Fed is behind and they're gonna panic
Mhm.
when things change drastically.
Mhm. We'll wait to see that for sure. We'll stay invested at this point. The U.S. housing market, according to Bloomberg, shows signs of life after mortgage rates fall. Like what you pointed out earlier, the mortgage rates have fallen down, way down from 7% down to low six. Low six, right? Let me see.
637 is what I saw earlier.
Yeah, 668, December 22nd. But it's way down from 8%, way down. So that's a good sign. So that kind of gives some hope for those future home buyers that have been patiently waiting on the sidelines. So if we run the math right now, you might save a couple $100 if you take 6% rate rather than the 8% rate.
Yeah, that's still a big chunk that you
Mm.
can use for other things.
Oh, all right, so I guess we have less than a minute left, but I guess this is just to point out the GDP now projected by Bank of Atlanta, they've increased it to 2.7% from 2.6 as of December 14th. So they're growing optimistic too. I think that we're going to end the show right there. Thank you, Wawi, for joining us again for another week.
Yeah, congratulations to everyone that hang on
Thank you. Yes,
and
congratulations to you
kept
too,
that
Wawi.
call.
Stay bullish, guys. Again, this is Mark Hughes signing out.
Wabi Santos signing out.